Shift. I'm in conversation with Upasana Chachra, Chief India Economist at Morgan Stanley, who joins us now. Upasana, thank you so much for taking time out for us.
Thank you, Pallavi. Always a pleasure.
Well, it's a pleasure for us to have you, but to dive straight into it, I do want to understand what's your expectation from the figures tomorrow, and is that also sort of likely to indicate the trends we're going to be seeing for the rest of the fiscal year?
So our expectation for the quarter ending June in terms of GDP and GVA numbers is pretty similar to what you laid out with the consensus numbers. We are in the same camp in terms of expecting a number which is sub 7% on GDP at 6.8 and on GVA a little lower at 6.5. So I think there are some impacts of the seasonality trends that we've seen in the past as well, i.e. the first half of the fiscal year tends to be a little weaker seasonally. And on top of that, we have seen, a little bit of an exaggerated trend in the June quarter due to elections, and that led to a slowdown in government spending, which has, repercussions in terms of government capex and also in terms of government consumption numbers and related numbers that we can see. So we do expect a moderation in terms of the GDP and GVA numbers, but I think if we were to look at GVA versus March quarter, then the trend is more steady or a little better versus what we saw. The March quarter GVA was at 6.3. So I think in terms of the year ahead as well, as you ask, I think our numbers are at 6.8 for fiscal 25, a little lower than RBI, and I don't think should be characterized as a big slowdown or a moderation, because GVA is something which probably remains more steady, but GDP will see a moderation versus fiscal 24, largely due to the normalization in the gap between GDP and GVA.
Okay, all right, Upasana. So, I do want to follow up on that. So broadly, given that GVA is expected to hold steady in Q1, what does that say about broader economic activity? Can we then safely say that economic momentum continues to remain fairly resilient in Q1? And the reason I'm asking that specifically is because there have been some concerns. We did see lower profitability from companies. IIP growth has been slower. So, I mean, how are you sort of piecing together that picture?
Sure. So I think, when you look at the sum of parts in terms of the GVA or the supply side of the economy into agri, industry and services, you're likely to see a moderation in the industrial segment, more specifically in the manufacturing segment in terms of growth impact. It is led by, as you mentioned, corporate profitability coming in weaker, getting impacted both by, the government spending sort of weaker, so some of the revenue line items, and also by the increase in input price pressure. So even if we were to just look at the trend in WPI, that has moved up in the June quarter versus where we were in the March quarter. And that is going to happen as well, because now the base is going to change and you're going to see more like the YOY numbers on WPI picking up as well. And that does impact your deflator and, may have some impact in terms of the profitability trends. So industrial activity, I think, will see some moderation in the YOY numbers. On the services side, though, the momentum remains pretty solid. So high frequency trends from PMI services or other high frequency data points such as air transport, air cargo, or the credit deposit numbers, etc., which go into the services segment data points. All of that have held up in the June quarter.
Right.
Gaining momentum, industrial activity moderates a bit.
Okay, all right, Upasana. So the momentum in services continues to remain intact, while manufacturing GVA might be a tad slower. But, shifting focus to expenditure side trends, consumption's one space we've been tracking closely over the last few quarters. Are you seeing steadier signs of recovery there as well? Are you seeing any weakening in urban consumption indicators, even as there are clear signs of a slow but steady recovery in rural? What's the consumption picture looking like?
So on the consumption side, we are seeing signs of pickup in the rural demand. So FMCG, say volume growth has picked up or it has outpaced urban for the first in the March quarter and back to back again in the June quarter as well. Again, we are seeing pickup in the two-wheeler sales and improvement in the tractor sales as well. More or less, most of the rural high frequency data points that you can track will show an improvement. So things like, work demanded under NREGA that has also moderated, so i.e. reflective of probably better trends in the rural economy at a broader level. On the urban consumption side, I think PV sales or auto passenger vehicle sales is one area which has seen a slowdown, and that has created a little bit of concern on urban demand. But I think if you look at the underlying drivers of urban demand, more specifically like labor market trends, those have actually at the margin improved. So like Naukri job index growth, that has actually been improving. So it's toughed out, and the YOY numbers are improving there. We are also seeing like on the CMI unemployment rate that did moderate a bit in the June quarter. So I think probably, I wouldn't really overplay the concerns on urban demand. I think the gap between rural and urban will likely narrow. But net, I would expect consumption to do better in fiscal 25 than what we saw in fiscal 24 if you have to look at the GDP numbers on consumption.
Okay, all right. So, again, continuing with expenditure side trends, one area of concern has been, the fact that this time, because of the general elections, we have seen a slowdown in government capex, and that's the segment that was largely driving growth last fiscal. So, what's the impact, and also what's the outlook going forward? Is it sort of a temporary blip we saw because of the general elections, and can we expect that space to continue to drive growth for the rest of the fiscal?
So on capex and more specifically public capex, so see the June quarter will probably be an aberration and we will see slowdown in government spending related line items, and that is more like an aberration for the June quarter. After that, the spending patterns have normalized and that will start reflecting in the numbers itself. But I think if you want to think about it like fiscal 25 versus fiscal 24, then we do expect a moderation in public capex. That is evident from the numbers in the budget as well. So they still remain pretty healthy. Like overall capex numbers are budgeted to be around 17% YOY, but it will be lower than what we saw in the previous years or previous 2, 3 years in terms of the CAGR growth rate. So the key would be for private corporate investments to pick up. June quarter high frequency data, especially if you look at CMI related data on private sector investments, new investments or projects under implementation, that has been weak in the June quarter as well. You can attribute it to the election event because that does just play a big role in terms of dampening activity in that sense. But I think probably from here on, you will see more increase in or greater traction on private corporate capex side as well, because some amount of green shoots have already been visible. It's just that June quarter, in terms of some of these new investment numbers, have been weak. So I think overall the balance on public versus private capex can shift, even though public capex growth remains relatively robust but lower than last year.
Okay, all right. So one last question before we can let you go, Pasna. You did partly answer that. I do want to ask you, however, once more about high frequency activity post Q1, how that's looking in the ongoing quarter, and also, given the whole host of factors at play. For the full year, would it be fair to say that at this point, given what the RBI's forecast is, we are looking at downside risks to that, and that's pretty much in line with what your forecast is as well for the full year?
So for high frequency data, we are, in terms of when we look at July numbers, it's sort of maintaining the trend momentum that we saw in the June quarter. And June quarter per se from a high frequency indicators basis was not like very, very strong because it was mixed with some of these industrial activity numbers moderating, services holding up. So July early reads or August early reads, the momentum hasn't changed meaningfully, and I would attribute it to the point that I made initially as well, that usually first half of the fiscal year tends to be seasonally weaker. July to September is also marked with the monsoon period, so construction activity, capex activity tends to take a back seat, and I think it will be more fair to assess high frequency numbers in the second half, and especially as the festive season starts to kick in. So I would expect that the momentum will pick up more meaningfully as we go into the third quarter of the fiscal year or more to the second half of the fiscal year. In terms of numbers, at the moment, we are comfortable with our 6.8 number. Yes, lower than RBI's at 7.2. As I mentioned, high frequency data as yet is not pointing to a momentum which is, at least indicating that we should be reassessing our numbers as of now. We'll obviously be waiting for the final numbers tomorrow to see, what's the actual data for June quarter looking like.
All right, that's fair. Thanks a lot for taking time out for us, Upasana. And do stay tuned to NDTV Profit for our coverage of the GDP figures.